Good afternoon. I'm Tim Nyland. I'm pleased to announce that I'm finally back on the air after going dark in mid-December of last year. In January of this year, I started a new role as Director of Research at Pacific Point Advisors in Rancho Santa Fe, California. Together with my team of analysts, we've built out a state-of-the-art research lab that will bring you a unique and timely perspective of analytical issues of relevance impacting financial markets today. Before we get started, please like, comment, and subscribe, and be sure to visit the Pacific Point Research Lab on our website at pacificpoint.net/research-lab. And while you're there, be sure to sign up to receive our research delivered directly into your email inbox. Let's go ahead and get started. Today, what we're going to do is we're going to look at these recession risks that we hear a lot about. Are we going into a recession? We're going to take a look at what's going on with the credit markets and how it's at odds with the equity markets, and really look at some of the long-term implications of where we go to from here in this market cycle, regardless of whether we actually go into a recession or not. What you're going to find is that these things take a lot longer to play out than we would normally otherwise expect. And you can see that here in this 35-year history of this 10-2 Treasury yield spread. Again, it's the credit markets that give us the best indication of whether or not we should expect a recession, right? As this 10-2 Treasury yield spread collapses, the likelihood of a recession increases. And when we get to levels like we're at now, where we're actually at levels we haven't seen since prior to the dotcom implosion, you can see that we're currently sitting at a negative 0.44. The low points we reached prior to the dot-com implosion were negative 0.48 in April of 2000 and negative 0.45 in August of 2000. Okay, so we're rapidly approaching those same levels. And you'll notice that, sometime between 12 and 18 months after this type of an inversion occurs, and what I mean by inversion is that the yield curve absolutely, inverts at these levels, you actually end up in recession. So that's the indicator that's being sent currently. You can see that that's been a strong, solid indicator for us, even going back here to the recession that we had in the early 90s. Okay, so let's take a closer look at what the Federal Reserve is up against, and it's really, really helpful to show you this type of a historical context so that you can gain a greater appreciation for some of the magnitude of these moves. And so it's important to understand the history of this headline CPI change. And what we're looking at here is CPI all items, and it's a 1-year percent change, specifically a 50-year history of it. And again, you can see that just prior to recessions, it's very common for this CPI number to begin to skyrocket. And then the Federal Reserve obviously steps in, raises rates. We're experiencing that now. And so shortly thereafter, when we see this type of inflationary event take place, you end up in recession. Now you can see we've had much, much lower levels of headline CPI change, specifically the 1 year, really since the early 1990s. As a matter of fact, we've been actually struggling with deflation rather than inflation. You can see that here all the way in this post-Great Recession era. Of CPI headline, really, really struggling to even hit that 2% mark. Okay, now we've skyrocketed as of the June read all the way up to a 9.1. So to understand and really appreciate what this means from the perspective of what you're hearing in the media and the Wall Street Journal and CNBC, you really need to understand how this actually works through the actual business cycle, if you will, the economic cycle, specifically on the corporate level, the business cycle. That's what we're going to look at right here. So what does this actually mean for U.S. corporations, whether we have a recession or not? Okay, this is the really, really important part. And this is going to really help us try to determine where markets might be heading. So same exact chart. All I've done now is I've added the labor productivity that you see here, and I think that's kind of a plum color or purple, and then the average hourly earnings. And I've normalized this chart so that we're looking at rates of change. So this is all specified in a 1-year percent change basis, which is really how you want to look at this, specifically from the perspective of a corporate P&L statement. So how do you look at a chart like this and draw conclusions, right? Well, the first thing that we know coming into this is that we've got really, really hot headline inflation. Again, this is CPI, all items. It includes the volatile food and energy category, and that's fine. What I want to point out here, and this is really, really important, is that we did have a wage price spiral take hold here really at the beginning of 2021. And you can see that that blue line and that green line kind of accelerating together in tandem is that feared wage price spiral. And we've still got a wage price spiral going on today. And the problem with it is that even though the inflation is accelerating at as of the June read, right, 9.1%, we've still got average hourly earnings sitting at 5.2, which is really, really elevated. This is a number the Federal Reserve does not like. And this is of all private employees. So this is the number that you see reported. So what does this mean? This basically means that even though employees have received on average, 5% pay increases year over year, inflation is clocking in at 9%. So effectively, they feel 4% poorer. This is the problem with inflation. It actually hits lower wage, lower income employees even harder. And so when you look at and you combine that together with labor productivity actually collapsing over this same time, when you get to a corporate P&L perspective, remember that employers are still on the hook for the 5% pay increases. When you start looking at operating margins and you quickly realize as a CFO that your employees aren't producing as much as they used to, and the per unit labor costs are going up to the tune of 5.22%, well, now it takes more employees to produce the same units of output, if you will, because productivity is essentially collapsed. Okay, so this is a real problem for margins, and realize that we are now sitting at the very top of a margin cycle when we look at broad-based S&P 500 composite type indicators. So a real risk here is that this 5.2%, as this inflation begins to roll over, right, which we're expecting headline especially to roll over, core is potentially going to be a little bit sticky because of the fact that real estate prices haven't really come down yet. Owner equivalent rents, which tend to trail that real estate valuation, certainly haven't come down. And this 5% pay raise ends up getting embedded longer term on corporate P&Ls. So as inflation begins to come down, right, and corporations are not able to pass along the cost increases in terms of price hikes to consumers, they're stuck with these higher wages. And therefore, the only way to restore their margin productivity, if you will, is to basically begin laying off employees. And that's where the trouble begins, right? So we've got margin erosion potential coming from several places. 3 places to be exact, right? Inflation rolling over, and these corporations not being able to pass along those costs along to their customers. Then you've got the problem of these wages, which are sticky, right, at the operating margin level. And you've got labor productivity that is essentially collapsed, okay? So it takes more employees to produce the same units of output. So all of these 3 factors combined, whether we go into a recession or not, are going to cause corporate profit margins to potentially roll over. And that's the big risk. And so when we look at earnings season, we tend to look at earnings season a little bit different. We like to scrub the actual transcripts and look for the qualitative type information that's embedded in these transcripts. So certainly we look at the headline numbers, we look at them relative to forecast, we have a great appreciation for that. But the rubber hits the road when we start looking at what are these factors of inflation, how are they trending, and where are they likely to trend? And the interesting thing is when you look at, in this case, I'm using the Call Street transcripts out of FactSet. And when you look at this for basically a universe of global stocks, 71% of the mentions of inflation came in earnings reports. Okay, so you can see these spikes during reporting season for the fiscal 12 type companies. But same thing for conference materials, corporate relations, mergers and acquisitions, guidance, right? So inflation being mentioned a lot. And you can see that trending up here. This is a 3-year history, so really started to trend up in January of this year. And if you were to just kind of draw an imaginary regression line here, you can see that those inflation mentions are really not coming down. As a matter of fact, I would guess that these inflation mentions are going to continue to increase because I think that there's this groupthink going on amongst corporate boards right now where they acknowledge that there's going to be pressures in the future, but it's not going to impact them, right? And when they finally realize that it is going to impact them, I think that you're going to see the mentions of inflation really begin to tick up because it's going to start eroding their margins, specifically at the operating margin level. And they're going to have to take action to restore those margins. Okay, so this is basically a 3-year history of the mentions of inflation against all these transcript sources out of FactSet for a global universe of stocks. Okay. So now what we'll do is we'll just focus in on the frequency of just that earnings portion. So that roughly 70%, we'll just take a look at that. And you can see that we've definitely had that increase in mentions of inflation. It's actually tapered down just a touch here, but again, something that we like to monitor, something to be aware of. We're not out of the woods yet on this whole concept of inflation. And the reason why we're not out of the woods yet and the reason why the Federal Reserve is in a really tight spot is this expectation of inflation, right? So when we start hearing, and paying attention to the pundits on television and what you read in the journal and other publications, you really get a sense for how everyone just wants this to be over so quickly. And the problem is that we have a 20-year history of inflation surprise. This is actually put together by Citibank and maintained. And this is a series that I absolutely love. It really kind of points right to the heart of the problem here when you're trying to listen to the pundits on television and try to get an idea of what's going on. When we were heading into this inflationary period, everybody said that this inflation was transitory. And you can see this quantifies the surprise associated with all of the inflation reads that came in post-COVID. You can see the average, 1 standard deviation positive, 2 standard deviations positive. When you get above 2 standard deviations on the positive side, you've got such inflationary surprise to the upside that economists, strategists, and Wall Street in general, no one really knows where inflation is going. And they haven't really since right after COVID. And you can see that in the charts. Once you hit here, 1 standard deviation on the positive side, yeah, it's transitory, but just keeps surprising. We're still 2 standard deviations above the average over this 20-year period. And what I want everyone to see is that really since the Great Recession, you can see that we really struggled even on the inflation surprise side. You can see the deflationary forces in effect where this surprise actually came in below average. So we were actually surprising to the downside. So then the Federal Reserve was putting more stimulus, trying to prop up so we can experience some inflation, right? 2% is pretty healthy for an economy that's established like the United States. And you can see that average is actually negative 2.15 for this 20-year period. So that constant deflationary force in effect, that's certainly not what's going on now. And so I hope that you gain a greater appreciation for what the Federal Reserve is up against. And I hope that this webinar really goes the distance for trying to explain exactly what the risks are from a corporate P&L perspective. There really are sizable risks that I don't think are being discounted in the market. And I think for everyone that you hear that says that we're going to have, inflation is just going to collapse and this thing's going to be over, and, early next year, the Fed's going to start cutting rates. I mean, that very well may be the case. But when you look at the more recent history of strategists and economists and Wall Street in general being able to accurately ascertain that inflation is going to be contained, they have been really, really off to the tune of 2 standard deviations to the positive side. So really, really missing the mark. So just pay attention to that, take it with a grain of salt, and challenge everything that you read and hear. That's the best thing to do. And stay conservative on your estimates. That's about it for today's session. Thank you for attending. I hope you enjoyed the illustrations of the 10-2 Treasury yield spread, the CPI, labor productivity, average hourly earnings coupled with the inflation surprise. Though you may have heard and read about these factors, seeing it in the charts brings a whole new level of appreciation and context to the scenarios the Federal Reserve is facing in their fight to tame inflation. If you have any questions or requests, please leave a comment or email us directly at info@pacificpoint.net, and be sure to connect with me on LinkedIn at Tim Nyland. To receive our research delivered directly into your inbox, please visit us at the Pacific Point website at pacificpoint.net and click on the Research Lab tab and sign up to receive our research delivered directly to your inbox. Thank you, and I'll speak to you next time.